Welcome, everyone. Today is our second event. Our first event, we talked about OB3, and within that, we talked about those credits that are expiring, the green energy, right? The clean vehicle credit, which expires at the end of September of 2025. We have the residential energy credits, which expire at the end of this year, December 31st of 2025. So let's get a refresher on what these qualifying credits entail, what the requirements are, and then we'll go over the expiration, what our plan is to talk to our clients about. Okay, if we have not met, I am so glad to meet you today. Glad you joined us. My name is Nadia Rodriguez. I am a practicing CPA out of Dallas, Texas. Been in business for over 15 years. I do work full time for Intuit as a staff tax content analyst. And what I do with them is just a bunch of tax research, just tax research to make sure that our products are aligned with tax consistency. But I also run my own solo tax practice, and it's just me. And I do have a small amount of clients that I provide mostly advisory services to. So we meet throughout the year to look at their small business and look at their financials and see what strategies we can implement so that when it comes to tax time, their tax return is almost done because there are no surprises we've met throughout the year. So I've been a certified tax coach since last year, since 2024, and I am a public speaker. And so my passion is really education. And that's why I've opened our community for us to learn together, grow together, and succeed together. So today we're going to talk about the clean vehicle credits. Now there's three types of clean vehicle. It has to do with the new, brand new clean vehicle. And when I say clean vehicle, I mean any electric vehicle, even hybrid vehicles, anything that you would have to plug in or are energy efficient. So clean vehicle is the same, it's the same term. It's just used throughout the IRS forms, throughout legislation. They refer to these type of vehicles as clean vehicles. But we do have three types of credits. It's for the new vehicle, the previously owned, which is the term they use, which really is a used vehicle, and also the commercial vehicle. What about this clean vehicle? Do you use it for business? Then that's considered a commercial clean vehicle. And then we're going to go over the residential energy credits when it comes to home improvements to your home and also energy producing improvements. Think about solar panel. And then we're going to go into at the end for Q&A, see if anybody has questions. If not, I do have some just tidbits to share with you of what public practice has been talking about, other accountants, other tax pros, and then also what clients have approached me with. So if we go to the first one, our new clean vehicle, what is a new clean vehicle? Like I said, electric vehicle, hybrid vehicle. Now that credit is all the way up to $7,500, but it is divided into two components. The 3750 is if the mineral components requirements is met, and then the 3750, the other 3750 is if the battery component requirements are met. So I'm going to go over what that means. And then we're going to talk about the modified adjusted gross income limitations because not every taxpayer can claim this credit. There are some income limitations that the taxpayer must meet in order to qualify for this credit. And the price of this vehicle. So it can't be a really expensive vehicle. We're going to talk about the price of the vehicle. Once you go over that price, you no longer would qualify for that credit. And the taxpayer, they must be considered a qualified buyer. Now, what does that mean? Again, we're going to go over that on a separate slide. Now, this is a non-refundable credit. Now, if we're familiar with non-refundable credits versus refundable, we know that when it's called non-refundable credit, it means it's limited up to the tax liability of the taxpayer. We will never receive a refund over the tax liability. It's limited to that amount. Versus a refundable credit, like the earned income credit, there could be a refund, even if the taxpayer has no tax liability. But if it is a refundable credit, there can be a refund. But this clean vehicle credit, it's not. It's a non-refundable credit. Now, when we talk about the mineral requirements for this vehicle, right? Not because it's Tesla or one of those vehicles do we assume they are considered clean vehicle. The tax legislation has come out and said, well, they have to meet two requirements. They have to meet either the critical mineral component requirement and also the battery component requirement. And that's for you to get the $7,500. Now, if you meet one or the other, then remember you only get $3,750. Now, when it comes to mineral requirements, the minimum percentage of minerals I've listed here, the language that it talks about that that are contained in that battery of that vehicle, they must have been sourced within the U.S. or a country that the U.S. has a free trade agreement. Now, what does that mean? Usually those are very few limited countries where the U.S. does not have any agreements with. We're thinking about North Korea. And then also the battery components. Those battery components must have been assembled and manufactured in North America. Now, if we think about it, how would I know if this vehicle that my client is buying is considered a clean vehicle? No worries, because at the time of the sale, the dealer actually has that responsibility of that VIN number. They have to run it through a website, and we can do it too. If you're curious, if you wanted to, when you get a taxpayer client that purchased a clean vehicle, you're going to need their VIN number anyway. So run that through the system. Here I've listed the website on where you could do a VIN lookup, and that will tell you exactly, does it meet the mineral requirements? Does it meet the battery requirements? So that's a good source. Also, the IRS, as long as you have a VIN, they have a database filled with all of everybody's VIN, and when it comes to clean vehicles, that they are going to tell you if it meets it or not. But a lot of this responsibility does fall on the dealer to first certify that these vehicles are clean vehicles. The time of sale report is required. So if you have a taxpayer client that is purchasing a clean vehicle, at the time of sale, they give out this paperwork when they're doing the financing, when they're purchasing the vehicle. Within that paperwork, the dealer is required to provide the taxpayer client a seller's report, a time of sale report. This is where it certifies the components of the minerals, the components of the battery. So yes, if you are thinking about having a client, purchase a vehicle like this, make sure that we put this as part of our organizer when it comes to collection of all of their documents next year. We need to see this clean vehicle seller report, and we must have the VIN because the VIN is required for the tax return. Now, when we talk about modified adjusted gross income, I know it's called modified adjusted gross income. On the tax return, you're not going to find a line item on the 1040 that says modified adjusted gross income. Instead, we have to compute this amount. And so I've included here the formula of how do you compute the modified adjusted gross income. Well, you start off with 1040, line 11. That line is adjusted gross income. From there, then you add back any income that was excluded related to foreign. Form 2555. These are rare, but if you do have a client that has that foreign income that is allowed to be excluded, you just have to add it back in order to get the total amount of the modified adjusted gross income. But again, most of the times, it's always going to be your adjusted gross income if that taxpayer does not have any of that excluded income. So modified adjusted gross income, or better known as MAGI. There are some MAGI limitations to modified adjusted gross income when it comes to the new clean vehicle. And so the taxpayer, their threshold is $300,000 for married filing joint, and you see here $150,000 for all others. Of course, head of household is $225,000. So once your taxpayer has modified adjusted gross income, if they're married filing joint, of more than $300,000, guess what? They're not going to qualify anymore. There's no phase down. It's just completely phased out. There's no more requirement. There's no more allowed clean vehicle, not even a partial credit. They phase out completely. And then, of course, we need to look at their modified adjusted gross income, not only for the current year, but also look at last year's. If you're filing the 2025 return, we're going to be looking at 2024 modified adjusted gross income. Now, why do they let us do this? Because if the client is out shopping for a clean vehicle, they meet all the battery requirements, they meet the modified adjusted gross income, and then they get a bonus. What about if they get a bonus at the end of the year and their modified adjusted gross income for the current year when they purchased the car kicks them out of this income limitation, so they no longer qualify? But no, The good thing is that we're able to look at last year's. We're able to look at 2024. So if you're filing 2025 return, look at 2024 as well, because this is a nice little thing that we got through the law where it says we're aware that things happen. Your income could have done great, your business could have done great, or maybe you got a nice bonus from your employer, Christmas bonus, and it kicked you out of the modified adjusted gross income threshold. Don't worry, look at as long as last year that modified adjusted gross income was under the threshold, then you would qualify for this credit. Now, here, when I talk about non-refundable credit, just giving you an example, the Form 8936, Schedule A of Form 8936 is what is required to be filed when you claim a clean vehicle credit, whether it be a new clean vehicle, whether it be a previously owned or a commercial. You do have to file this form. But if you see here on line 12, we have a tentative credit of $7,500. For this example, this clean vehicle met all of the requirements, so we're at 7,500. However, if you see the taxpayer in this example, line 16, that's their tax liability, 3,983, which is less than the 7,500. So then the credit gets limited on line 20. And then the rest, what happens to the rest? We lose it. It does not get carried forward on a new clean vehicle or a personal or a used clean vehicle credit. Only if you use it for personal use, we're going to talk about when you use it for the business, but when you use it for personal use, you lose the credit. You use it or you lose it. Now, the clean vehicle, the new clean vehicle, there are some limitations on the price that you pay for it. Now, it's not the just sales price, it's the MSRP, which is the manufactured suggested retail price. Most likely you see these on the window of the vehicle if you go shopping at the dealership. They will display under the MSRP, the starting MSRP, and then if they add on, the wheels, the rims, the technology on it, then that price goes up of what you pay for it. But what we care about is manufactured suggested retail price, the MSRP. Anything above that, it doesn't matter. We care about the MSRP. Make sure that we look at that in the sales contract for our clients. So we see here for vans that are considered clean vehicle. Remember, they met the battery requirements, the mineral requirements. The vans cannot be greater than $80,000 of a MSRP. SUVs, again, 80,000. Pickup trucks, but then others, which is your sedans, not your trucks, not your SUVs, not your vans, 55,000 is the most that vehicle can cost for an MSRP. So that if the MSRP is $55,001, no longer qualifies. We need to make sure that the MSRP is either these amounts or under. Now, when I talked about qualified buyer, a new clean vehicle credit is only allowed to those that are called qualified buyers, and this is how they're defined. This qualified buyer, you would be considered a qualified buyer if you purchase this new clean vehicle for original use. You're not planning to gift it, you're not planning to sell it. This is for your original use. And you cannot acquire, like I said, for resale. And it's primarily used in the US. Yes, you can travel past the US, but if it's primarily used within the US, then you are a qualified buyer. You can't buy it here and then ship it out to another country and just have them use it there. Now, you do have to purchase the vehicle from a qualified manufacturer. And who is a qualified manufacturer? That would be the dealership. You have to ask that question, are you a qualified manufacturer? Most likely they are the bigger, Toyota, the ones that we know, and see the big lots, the big car lots. What about those small car lots? Are they a qualified manufacturer? That is something that we need to have our clients verify that that dealer does qualify, because a qualified manufacturer now falls under different rules with the IRS, where they have to send paperwork into the IRS when one of their clean vehicles are sold. So we do want to make sure that that end is at least required as a qualified manufacturer. Now, the weight of this new clean vehicle it has to be less than 14,000 pounds. And again, the final assembly must have happened here in North America. Now, how do we know? Again, the VIN number will let us know. And when you talk about previously owned, like I said, that's the term that is used throughout the IRS forms. It's really a used clean vehicle. It's not, you're not the first owner, but there are rules we have to meet. Now, the credit does is the lesser of. It's a lesser credit than the 7,500 of the new clean vehicle. Now, for previously owned vehicles, the max credit is $44,000 or 30% of the vehicle sales price. Now, I am saying sales price, not MSRP. So then we're going to talk about what is a sales price. So the lesser of 4,000 or 30% of the sales price. We also have income limitations, the modified adjusted gross income limitations, and also the price of that vehicle. They're different numbers than what we saw for the new clean vehicle. And the taxpayer must be considered a qualified buyer, which I'm going to talk about what that means when it comes to previously owned vehicles. And again, it's a non-refundable credit limited to the taxpayer's tax liability. Now, the modified adjusted gross income, you see they're cut in half for those previously owned clean vehicle credits. $150,000 for married filing joint. Again, married filing joint couple, once they make over $150,000, they don't qualify for a previously owned clean vehicle. 75,000 for all others, 112,500 for head of household. Again, this is a great thing that comes into law is that we can look at not only the current year modified adjusted gross income, but also look at last year's. Compare both of them, whichever is the lower of, as long as they're under the threshold, then they would qualify for the previously owned vehicle credit. The purchase price. Remember, we talked about modify or the manufacturer, sellers, retail price, the MSRP, that is what matters for a new clean vehicle. Now, when we talked about used or previously owned clean vehicles, it's the purchase price that we care about. There's a cap. This vehicle could not have been a purchase price of over $25,000, which is pretty low. Not sure if anybody has been out there car shopping for these electric vehicles. Have you found a used clean vehicle for $25,000 or less? If you do, let us know. But that is the purchase price cap. Once it's over 25,000, no longer qualify for this credit. So what is the purchase price or the sales price? Well, it's considered the total price agreed upon by the buyer and seller. We know that, the law of economics, right? That's whatever the dealer is willing to sell it to you, whatever you as the buyer are willing to pay for it. Now, the retail price of each accessory that is attached to the vehicle must be added as part of the purchase price. The delivery charges and the application of any incentives, maybe they're giving a $500 rebate, all of that has to be considered into the purchase price. But what is not the purchase price? What is not considered part of a purchase price? It's those taxes, those fees, any trade-in value, any separate financing, or those extended warranties that they always try to convince you to buy. That's not part of the purchase price. So we don't have to consider that as part of the purchase price. So yes, definitely use this slide if you do have a client that purchases a previously owned clean vehicle, so that when you're looking at that sales contract, you can figure out the total amount of what a purchase price is versus what not the purchase price is. Now, qualified buyer for the previously owned vehicle credit, these are a little bit different. Not too different, but there are some differences of what a qualified buyer is considered. It's one that, of course, buys it for use and not for resale, which we saw that with the new clean vehicle. And this is different though. Look at bullet point number 2, not a dependent of another taxpayer. We didn't see that with the previously clean vehicle, but we do with, well, I'm sorry, with the new clean vehicle, that didn't matter. Previously owned clean vehicle, it does matter. You cannot be a dependent of another taxpayer. And they also have a 3-year look back from the date of the purchase, which means the taxpayer could not have claimed this type of previously owned credit in a 3 year in the prior 3 years. So it's only allowed once every 3 years. It doesn't matter going forward because this credit expires just like the new clean vehicle credit expires as of October 1st of 2025. The qualified vehicle age. So how old can this used vehicle be? Well, first we need to talk about how many previous owners could this vehicle have had? And it's only one. Only one allowed previous owner is considered for this previously owned vehicle. So yes, it couldn't have been, you're the fourth owner, fifth owner. You have to have been, you, the taxpayer purchasing this previously owned vehicle, has to have been the second owner on this vehicle. So they won't allow any other vehicles that have been sold and resold and sold and resold. That would disqualify it. And then the purchase has to come from a licensed dealer. Now, if we talk about the model of this vehicle, can it be a very old model when energy credit or electric vehicles just started coming out to the market? Well, let's look at this example. Let's say you have a taxpayer client who does listen to you and goes out and purchases this clean vehicle, right? It's a previously owned clean vehicle, and they purchased it on August 5th, or they purchased it on August 5th, 2025. So the calendar year when they do buy the vehicle is this year, 2025. 2025 minus 2 is 2023. So the actual vehicle model for this example is a 2023 model. That does qualify because it cannot be an older vehicle than that. So it's a 2023 or earlier. Now, when it comes to tax planning for our clients, if they're whether they're shopping for a new clean vehicle, new EV, or a previously owned, we do have to start thinking about, well, what is their modified adjusted gross income? Do they qualify under those thresholds? Are they making more than $300,000 if they're married, filing joint? Well, they don't even qualify. We don't have to worry about a VIN. We don't have to worry about battery components. They just will not qualify for that new clean vehicle because they are phased out on their income. But if it's a previously owned, a used vehicle, then that's a lower income threshold that we also have to pay attention to. Then we have to really look into, what is it, an MSRP that we're interested in, which is the new clean vehicle, or is it the purchase price that we're interested in for the previously owned? And the VIN, of course, we can't file a tax return, at least electronically, and it most likely will get delayed if you paper file if we do not include the VIN on the Form 8936. We need to know the date of purchase. When did they purchase this vehicle? Because now with OB3, with the One Big Beautiful Bill, if they purchase this vehicle October 1st of 2025 or later, they will no longer qualify for this type of credit. And we need to ask for a copy of that seller's report, the dealer's report. Again, just to make sure that all the battery components are met, the final assembly happened in North America. And then if you need to know, if you're curious, or your client is curious, or maybe you want to send out an email talking about this clean vehicle credit and the expiration date coming up, I would attach this website that you see listed here so that they can go on their own and do some car shopping to see if that Tesla they're looking at, or that one hybrid vehicle that they're looking at, if those are qualified clean vehicles. Now, there is a transfer election when it comes to clean vehicles, whether it be a new clean vehicle or a previously owned clean vehicle, and that happens at the dealership. Not sure if you've been to the dealerships anytime recent, or even on ads or commercials that you see online. Usually dealers are offering a $7,500 off the purchase price. Now, what that means is that not from the goodness of their heart, most likely they're giving you a reduction of 7,500. And so what they're doing is this transfer election, because the taxpayer does have the option to transfer their credit, assuming that everything is met. And this is what the slide is talking about. Assuming our taxpayer meets all other requirements, their modified adjusted gross income is below the threshold, the purchase price or the MSRP of that vehicle qualifies, it's under those threshold limits also. Assuming everything is perfect and they qualify for everything, at the time of sale, the taxpayer can elect to just transfer that $7,500 of a credit over to the dealer. And then what that does, it does reduce the purchase price. It does reduce what the client is paying at the end of the day for that vehicle. This is not taxable to the client, to the taxpayer client, and it's not a deduction on the books for the dealership. Now, in order for this to happen, it does have to happen at the time of sale. Your client could have not just found out about it today and wants to go back to the dealership that they purchased the vehicle last week, last month, and try to do this. That's not something they can, it has to be done at the time of sale and say, I want to transfer my credit over to you, dealer. And what's the benefit? They get the financial benefit today. They don't have to wait until they file the tax return. Now, also, and I'll go over some more planning in a minute here, but the credit transfers per year, the taxpayer may elect to transfer this new clean vehicle or previously owned vehicle. Oh, when it comes to new clean vehicles, they can transfer a maximum of 2 per year. So it can happen. They can go purchase 2 vehicles and transfer both of those credits over to the dealer that same year. When we talk about previously owned, they have to wait every 3 years. So they can't be doing it. If they did it last year, they can't do it again this year. So yes, the question to transfer or not to transfer, is that a good tax planning tip for our clients? I would say yes, especially if the taxpayer doesn't have to wait, right, until April 15 to see the effect of that credit on their tax return. Instead, go ahead and reduce that purchase price of the vehicle. Maybe there's some negotiation that they can do, but they can receive it right then and there when they're purchasing that vehicle. And also, the taxpayer will not have tax to use the credit, because remember, this is a non-refundable credit. What about if our client does not have enough tax liability to use the 7,500? Then we lose it, right? We lose it. It doesn't get carried forward. Well, this is a good way to work around that. If we do have a client that has very little tax liability, but all other factors, they qualify for this clean vehicle credit, whether it be a new clean vehicle or previously owned, and they don't have enough tax liability, well, guess what? They can receive the total $7,500 at the time of sale. Because if they wait until April 15 when they file their return, they're not going to see the 7,500 benefit. They're only going to see the benefit up to the tax liability. Now we talk about commercial clean vehicles. So what this is, it's really a clean vehicle that is used for the business. Now that credit, first let's talk about the rules. It does have to be acquired for use or for lease. Oh, sorry, there is some noise in the background. It does have to be for use in the business. You're using it for the business, or if you are in the business of leasing a vehicle, then that qualifies as well. Think about like the app Turo, right? They lease out those vehicles. If you are buying vehicles that are commercially clean, that are used clean vehicles like Tesla, Cybertruck, and you're using it for your business of renting out those vehicles, you're leasing out those vehicles, you qualify for this type of credit. Or if you are a business owner and you're going to use your clean vehicle, that electric vehicle, you're going to use it for the business, it's considered a commercial clean vehicle. And these are the rules that you must meet. Now, the vehicle, like I said, must be for business use. So the IRS is going to expect to see that vehicle on a depreciation schedule. So yes, it must be depreciable property, because that's what we do with assets that we buy for the business. They are depreciable property. Now the credit is a little bit different. The amount of credit, it is maxed at 7,500 if you're weighing at less than 14,000 pounds of that vehicle, but it is computed as a lesser of 15% of the vehicle's basis, or 30% if it's a vehicle that's not powered at all by gasoline. If it's completely electric, then it's 30%. So it's the lesser of the 30%, or what they call the incremental cost. Now, if you want to find out what the incremental cost is, there is a revenue procedure that you'll find online, but rule of thumb, most likely it's going to be, if you go through all of that, it's going to be $7,500. Now, here are the limitations. We talked about the battery components and the mineral components. If you see here on this bullet, which is what, the 5th bullet point, it talks about what is considered a clean vehicle when it comes to commercial clean vehicles, those vehicles that are used in the business. The electric motor powder must be powered by a battery with a capacity of not less than 15 kilowatts per hour. And the weight of, again, has to be under 14,000. Now, I am talking about only the $7,500 credit for clean vehicles that are used for business. Now, how do we know about the 15 kilowatts or the 7 kilowatts? Again, the VIN, the seller's report, the dealership report will tell us this information. But look at the maximum credit amount. If we have a vehicle that is under the 14,000 pounds, the max credit is 7,500. But all other vehicles that are heavier than this, the max credit is 40,000. Now remember our formula, it's the lesser of 15% of the vehicle's basis or that incremental cost. But vehicles can be up to $40,000 of a credit if you're using that vehicle for business. Now, most of these clients that I have are purchasing clean vehicles used for the business, but they're under the 14,000 pounds. So it's going to be a $7,500 credit for them. The $40,000 credit, I'm seeing this in like companies like Amazon. I don't know if you've seen the new Amazon trucks, the most updated, those are 100% electric vehicles. They're heavier than the 14,000. Now they're probably benefiting from something that as much as the $40,000 of a max credit for these clean vehicles that are used for the business. Now, the thing about a commercial clean vehicle credit, if you use this for the business, again, that's considered commercial clean vehicle. It's a non-refundable credit. Okay, we're familiar with that, right? It's not refundable. But the great thing about this type of credit is that you can actually carry it back 1 year or carry it forward up to 20 years if you don't use it all because maybe you didn't have enough tax liability. So that's a great thing. You can carry it forward versus the other two that we just saw, the new clean vehicle and the previously owned, those that are personal use, those we use it or we lose it, right? There's no carry forward. Commercial clean vehicle credits, it is a carry forward. So when we have our clients that are thinking about purchasing a vehicle for the business, we need to consider the cost of the vehicle, right? Let's talk about how much is the cost, because again, we need to calculate that 15% or 30% of the basis or the incremental cost. And then the cost benefit, right? Not because it's maybe we have a client who does a lot of driving and maybe it's not convenient for them. Maybe they haven't thought about, not only are they getting a nice credit, but let's also talk about the cost time value. Are they going to take longer to charge that vehicle and that's time off the clock that they'd rather be driving is going to hinder their business, especially if they're in the business of delivering or driving a lot. Let's have that conversation with them as well. Again, the VIN number, we're going to need that for the tax return. We're going to have to know the date of purchase. Of course, that's on the sales contract and the tax liability. Maybe in the future, maybe in 2026, they have a greater liability that they can use this credit. And in 2025, their liability is pretty low. But guess what? How we talked about, we can carry forward the clean vehicle credit that is used for the business, the commercial clean vehicle credit. Now, when we do put this on the books, on the depreciation schedule, we do have to reduce the cost of that vehicle minus the credit that we were able to claim or that is even carried forward. We need to reduce that basis of that vehicle when it goes on the depreciation schedule. Just a reminder, with the one big beautiful bill, the sale must be finalized for the clean vehicle, whether it be the new clean vehicle, the previously owned, or the commercial clean vehicle. Has to be finalized, signed. All documents must be signed, finalized by September 30th of 2025. After that, it completely goes away. It's no longer valid. So do make sure that we do communicate that with our clients, that awareness, um, because we do have a date coming up pretty soon. We're already in August, and it's coming up September 30th as our deadline for these clean vehicle credits. Okay, so now let's talk about the residential energy credits. Again, this one expires at the end of this year of 2025. So December 31st of 2025 is the last day for this residential energy credit. When we talk about residential energy credits, we have two types of credits for the residents. One is a home improvement. Think about here the examples, the exterior door, the windows, the skylights, the ACs. Now, this credit is limited to 30% of that cost of that improvement, but it is limited to what you see here, and it's an aggregate. So you could have done an exterior door for it's 250 per exterior door. So if you have 7 doors and it's a limit, the limit cannot go over $500. And then we go on to the next kind of energy properties, improvements, the windows, the ACs, that's only $600. Now remember, we are talking about either 30% of the cost or up to $600 maximum limit, the lesser of the two. And then we have home energy audits. That's $150 of a credit. So yes, if you have a taxpayer or even yourself, you're doing all these improvements to your home, the exterior doors, the windows, the AC, the energy audit, all of that has a max of what you see on this table. And if you add them all up, it's a max of $1,200 of a credit, of a home improvement credit. So it's not too much. And then we also have an extra $2,000 limit, but this is very limited to those electric or natural gas heat pump water heaters. We don't have any here in Texas. I think those are more like in the Midwest or in the North, these heat pumps. And that's a $2,000 limit on that. So really, the total home improvement residential energy credit is a max of 3,200. That's if you spend all your money on doing all these improvements. It's $1,200 for those improvements that we saw on the previous slide, which is like the windows, the doors, the AC units, and it's $2,000 for these natural gas or electric gas or electric heat pump water heaters, or the gas heat pumps, the biomass stoves, and the boilers. Now, it can be claimed on a primary residence, these energy credits, or on a vacation home, a second residence. Now, it can't be claimed on a rental, not at least through this type of Internal Revenue Code section of 25C. The tenant, if you are a landlord and your tenant is willing and wanting to make improvements to the home, they are the ones who will receive the credit. Yeah, you can make these improvements if you wanted to a home that you're renting out, or that you are renting it from a landlord. You as the tenant can take this credit. Now, this credit does have to be claimed on the 5695. It always has, and it will continue to be. But if we go into 2025, so this is the requirement that has been law starting this year of 2025, is that those home improvements, those ACs, those windows, those doors, the geothermal gas pumps that we were looking at, for the 2025 return that we file in the year 2026, it does say, so far the instructions have said, we must include a product identification number on the tax return. I know we talked about what kind of numbers are required on the tax return, which is the VIN for those clean vehicle credits. For these type of improvements starting 2025, which is the returns that we file at the beginning of 2026, we're going to need from our clients their product identification numbers on those ACs, on those window purchases. Now, I did put a note here because this is one of the things that I talked about with the tax practitioners. Now that the One Big Beautiful Bill, OB3, has basically terminated this type of credit for the end of the year, will this still be required by the IRS? Are they really going to put that much emphasis still on having the manufacturer provide this identification number and then having the taxpayer for us to go and try to chase that product identification number? It's still unknown. We still don't know if this is still going to be the case. But as of today, if there's no guidance yet, so far it looks like we are going to have to ask our clients for this product identification number. Hopefully they're saving that. Hopefully there's an easy way to retrieve that. Let's start talking to our clients about this, or those that are thinking about making these improvements. Hey, when you purchase that, make sure to save your receipt. Make sure to save that product identification number. Now, the residential clean energy credit. This falls under Internal Revenue Code section at 25D, I believe. Now, this is the higher energy credit, right? We looked at the residential improvements was the max was 3,200, and then gets divided even further with all those limitations for those improvements like the AC, the exterior doors. This is the energy credit producing energy property, which is your solar panels. That's the most known under this clean energy credit. That credit is limited to 30% of the overall cost for the installation, including the labor costs for those solar panels or for that energy producing property, including the sales tax. It's 30% of that entire cost. Whatever you paid for, installation, sales tax, everything, 30% of it. Now it does terminate at the end of 2025. So if we're thinking about for our own homes having these solar panels, or we have clients that are thinking about this, we need to make them aware of this, that they do have to make this sale completed and producing the energy by the end of the year. They cannot prepay for solar energy, solar panels on December 31st and have them installed the year after in January or February, because it has to be completed, installed, and in functioning order by December 31st of 2025. Now, there's no limit on the eligible costs. Like I said, it could be solar panels that are worth $100,000, $200,000. These are big ticket items. You just get 30% of it, which again, there's no limit on how much that costs you, that energy producing property costs you for your home. Now, the credit can be carried forward. We were thinking about with the tax industry, we're talking about this. If now that this credit is going away with one big beautiful bill, are we losing those carry forward credits? I do have a client actually who has been carrying forward their solar energy credit since 2 years ago. And are they going to lose it? Nothing in the law that has come out has said whether this is going to go away. So most of the people in the tax industry have said the carry forwards will continue. You just cannot produce new credits starting 2026. Now, these type of energy property is allowed on the existing home or even in a new construction. But again, it has to be completed by December 31st of 2025. And so the home, it could be on a home that is used as a residence. Doesn't really mean it has to be your principal residence. Again, think about those vacation homes, the secondary homes. Now, here's a list of what those clean energy credit, the qualifying property that produces that energy, a list of what we have here that is allowed. We see the solar energy, the solar panels, the most famous, but then also look at the one towards the bottom. I bolded that, which is the battery storage technology expenditures, right? Do you have a client who's thinking about installing these type of storage technology in their garage to charge up the Tesla, the electric vehicle? This also qualifies, but again, it has to be done by the end of the year of 2025. Now, if you're not too sure if the certain property, either the improvement that your client is thinking about or the energy producing property qualifies or how much it would qualify for, there are two websites, the Energy Star website, which on your handout we will include as part of the recording. You'll be able to click on this link, and also the U.S. Department of Energy website. Now, is that something we would want to do? I usually give this responsibility to the client and have them look into, go search for that AC that you purchased. That would be a good indication if it is qualified energy property, qualified energy improvement.